Hello and welcome. In this video, we will learn about the small players of stock market. Alright? Now the stock market has different types of players. And by players, I mean people or institutions who buy or sell shares from the stock market. Okay? Now these players are of two types. One is small players and another one is big players. Okay. In small players, we have investors, traders, arbitrators, and hedgers. And in big players, we have all these, which we will learn about in the next video. Okay. Now, small players are the ones who have limited amount of capital to buy or sell shares, and big players are the ones who have a lot of money to invest in stock market. Okay, now let us start with investor and trader and later cover arbitrator and hedger. Okay, now on the left side are the qualities of the investor, and on the right side are the qualities of a trader. Alright. Now I and you can be an investor or a trader. Okay. I and you are the people with limited amount of money. So we can be an investor or a trader. Okay. It depends on the qualities that are mentioned here. Alright. Now investor wants to be in the stock market for a long time. So when a person puts money in the stock market, he waits for a long time so that the money that he has put in grows. Okay? Whereas the trader wants to make money quickly. So he will not be putting in money into the stock market and wait for a long time. He is not willing to do that. He wants to make quick money. Okay. Now, an investor wants the business to grow. Why? Because only when the business grows, the wealth of investor grows. Meaning, if he has invested his money in a particular business, then when the business grows, that money also grows or the wealth grows. So he wants the business to grow. Whereas the trader doesn't care about the business. Okay? He just purchases the share when it is at low price and sells it off when it increases, or he sells the shares when it is at high price and then buys it back when it decreases. Okay, so he doesn't care about the business. He doesn't care what happens to the business. He just wants to buy and sell shares many times or as many times as possible. Okay. Now, if a person wants to invest in a business for a long time, then he needs to study fundamental analysis, or he needs to know fundamental analysis. Okay. So an investor does fundamental analysis of the company that he wants to invest in before investing. Whereas a trader doesn't learn fundamental analysis, doesn't care about fundamental analysis. He learns technical analysis instead. Okay? He learns technical analysis before trading. Alright? So remember that this person is investing, this person is trading. Now what is fundamental analysis? Fundamental analysis is something that a person must do before investing in a company. He has to know how much profit a company is getting, how much loan does it have from the bank, how much shareholding is there, what are the areas in which they are investing or they are having their business in, and so on. Okay. Now I have a separate playlist on fundamental analysis which you can go through to learn how to invest in stocks. Okay. So it is out of scope of this video, so I'm not going to elaborate on it. Technical analysis deals with indicators and charts. Okay. So candlestick patterns, you might have heard about it. Once again, I have a playlist about technical analysis too, which you can go through if you are interested. I'm not going to elaborate here because it is a very huge topic. Alright. Next, an investor is interested in bonus shares, dividends, rights issues, and much more, because all these will increase his wealth. Whereas the trader is not interested in any of this unless this or these have an impact on the movement of the price of stocks. Okay. Sometimes when a company issues bonus shares or dividends, the price may fluctuate. It may move up or down. It depends on sentiment of people. Okay. So if that affects the price movement, then the trader will be interested in it. Other than that, he will not be interested in these. Okay. An investor generally invests in stocks. He buys stocks and keeps on buying stocks. Whereas a trader can trade stocks or futures and options. Okay. So futures and options are called as derivatives. Once again, it is a very big topic. I have separate playlist on futures and also options, so you can learn about them by watching the videos. Alright. Now trader trades stocks and also futures and options, whereas investor invests in stocks. Okay. And an investor wants the price to go up gradually. He is not bothered if the price comes down, if the price moves up. In a long term, it has to move up. But in a short term, if it comes down, he is not worried about that. He just wants the price to go up gradually over the time. Whereas the trader wants the price to go up and down frequently. Okay, that is how he is going to make money. He buys low, sells high, or sells high, buys low. So if there is no fluctuation in price, or what we call as volatility, if there is no volatility, then the trader is not going to make any money. Okay, so trader wants the price to go up and down frequently. All right. Yes. So these are the features of investor and the trader. So people with small amount of money, people like you and I, can either be an investor or a trader. Okay. Now, arbitrator. So who is an arbitrator? Let us see that. Okay. Now let me give an example. Let us say the shares or stocks of Tata Motors is being traded at 400 rupees in NSE and 410 in BSE. Okay. Now, NSE is a stock exchange. BSE is also a stock exchange. What is a stock exchange? Stock exchange is nothing but a shop. Okay. I had given you an example of shops. So you can buy Tata Motor shares from this shop or this shop. Okay. Just like if you want to buy a fruit or a vegetable from the market, you can buy it from different shops. You can go to a local market or you can go to a mall. Alright. The price in NSE is 400 and the price in BSE is 410. Okay. So generally the price in different stock exchanges vary. Okay, stock exchanges vary. So if you want to buy a Tata Motors share from NSE, you need to pay 400 rupees per share. If you want to buy one share of Tata Motors from BSE, you need to pay 410 rupees. Okay. Now, there will not be this much gap. Okay. I have exaggerated to explain you the concept. Alright. Now, who is an arbitrator? An arbitrator is a person who simultaneously buys from one and sells in another. Buys from one shop and sells in another shop. Now, just imagine, can't you buy a stock at 400 rupees from NSE and then sell it at 410 in BSE? Or let me put it this way, can't you buy 1 kg of apple from a local market at 400 rupees per kg and then go to a mall and sell it to others at 410 rupees per kg? And by doing that, you are earning 10 rupees per kg of apple. Imagine you buy 1000 kgs of apple at 400 rupees and sell those at 410 rupees in a mall. So how much money can you make? Can you imagine? Right? So that is what an arbitrator does. He buys from one stock exchange where the price is low and then simultaneously sells it in another stock exchange where the price is high. For example, he buys 1000 shares from NSE, this shop, at 400 rupees each and simultaneously sells the share in BSE at 410. Okay. So on each share he is making a profit of 10 rupees and that is his plan or strategy. Okay. So he is not in for long term, he is not in for short term, he doesn't want the price to go up gradually, he doesn't want the price to fluctuate, he just wants to sell from one shop and buy from one shop and sell it at another. Okay. Now this is an image from Zerodha platform from today. Okay. So you can see this is Tata Motors and this is from NSE. Nothing is written here. This is from Tata Motors and this is from BSE. You can see BSE here. And you can see the price difference here. Tata Motors in NSE is being traded at 416 rupees and 65 paise. Whereas Tata Motors in BSE is being traded at 416.75 rupees. That means if you want to buy one share from NSE, you have to pay this much. If you want to buy one share from BSE, you need to pay this much. Okay. Now the price difference depends on various factors which you do not have to worry about. Okay. So amount of volume being traded and volatility, everything counts for the price difference. And you can see the price difference is very, very small here. Alright. Now you can do this too, but most of the time it will not work. Okay. Now the thing is, see, just imagine when you try to buy from NSE in large quantities, what happens to the price? The price goes up. Correct? More demand, so the price goes up. When you sell shares in large quantity, what happens to the price? The price goes down. Okay, price goes down. So the supply is more. So price goes up, price goes down. So due to this, you will not be able to make much of a profit here. Alright, but then people or arbitrators do this and earn some profit. Okay, earn some profit. So they will be on a lookout for this price variation and they trade to earn some profit. Okay, and we have something called as futures, which I have not taught you till now. So they buy shares, sell futures, they do many things when the price difference occurs. Okay, but basically this is what arbitration means. Now I have taught about this in a different playlist. You can go and look there. Okay, so that is enough for now. Alright, so this is one more player in the stock market. And the fourth player is hedger. Okay, hedger. What hedger does is called as hedging. Alright, hedging. And once again, I have taught about hedging in options and futures playlist. You can go there and watch the video to learn about it in detail. I'm not going to teach you in detail in this video because it will take a lot of time. Alright. Now, let us assume that you are a hedger or I can say you are an investor. Right? You are a person who has invested money in the stock market. You are an investor. Now you have stocks worth this much rupees. Okay? 1 crore rupees. Alright? You have stocks worth 1 crore rupees in your portfolio. Let us assume that. Now, according to your analysis says that the value of your stocks will go down to 70 lakhs in the next 2 weeks. Okay. So according to your analysis, you are predicting that the price or the value of this will go down to this. There is 30 lakh difference here. Okay. Now your analysis may be right or wrong because no one can analyze stock market perfectly. Okay. Now you have a concern. You do not want this to happen. Okay. What you can do is you can sell entire shares or stocks that you have at this price now, and after 2 weeks you can buy it at this price. Alright. Now this is one thing that you can do. But generally people do not do that because it has a lot of other things associated with that. Okay. The brokerage charges, taxes and other stuffs. And also what if the price goes up after you sell it? Correct? So people generally do not sell and buy low. The other things that you can do are these. You can sell futures of the stocks, you can sell call options, or you can buy put options. Okay. Now once again, I have not explained about futures and options, so this doesn't make much sense to you. Alright, so do not worry about this right now. But just remember that by doing this, a person can maintain the portfolio intact. Okay, I am putting it in simple words here. Alright. So now let us imagine what happens. If your analysis goes wrong and the price goes up, the value of your portfolio goes up, whereas this goes down. Okay, this goes down. If your analysis goes right and if this price goes down, then the price of this goes up. So it will balance out. Okay. If you lose money in your portfolio, you gain here. If you gain in your portfolio, you lose here. Okay. And by doing this, the person maintains his portfolio intact. Okay. And if you do this, then it is called as hedging. Okay, hedging. And the person who does is hedger. Alright, hedger. Now, hedging and arbitration is done by people who have lots of money. Okay, it is done by people who have lots of money, institutions or people who have lots of money. Alright? Whereas investing and trading is done by people like you and me. Alright? Yes. So these are the four main players who are small in stock market. Alright? In the next video, we will learn about the big players of the stock market. Alright? So I'll see you in the next video. Till then, take care and thank you for watching.